You are listening to Lender Lounge with Kevin Kim, a podcast dedicated to helping those in the private lending industry grow, improve, and streamline their business. I'm Kevin Kim, partner at Gerasi LLP, the nation's largest private lending law firm. Join me as we chat with the best and brightest in private lending, who are eager to share their years of wisdom and best practices with lenders, borrowers, brokers, investors, and more. Subscribe to Lender Lounge on your favorite podcast platform and learn more about Gerasi and how we can work with you at gerasilawfirm.com. Check out the episode summary for other valuable resources. Hey guys, Kevin Kim coming to you with another episode of Lender Lounge. We are now in season 4. We have a little bit of a new setup here. We're going to use a new online studio, and to break off the new season of Lender Lounge, I am privileged to have the new CEO of Kiavi, formerly known as LendingHome. Arvind, welcome to the show.
Yeah, Kevin, thanks so much for having me. Super excited to be on, and looking forward to the conversation.
Well, for our audience, please introduce yourself and a little bit about Kiavi, and we'll get into it.
Yeah, perfect. Yeah, my name is Arvind Mohan. I'm the CEO at Kiavi. Kiavi is a technology-enabled lender to real estate investors. We harness the power of technology and data to offer our real estate investors customers a faster, simpler process, as well as quicker access to capital to enable them to scale their businesses. Our customers are, serving the purpose of bringing more move-in-ready homes into the market. It's about 25 trillion of the aged housing stock in the country, and especially in this environment where you see like a lack of move-in-ready properties. Customers are serving a very important purpose in bringing that to market and enabling more people to kind of move into new homes.
It's fantastic, and I mean, LendingHome / now Kiavi is definitely a household name, probably number one lender in many, many big markets, but our audience, most of our audience knows Kiavi quite well, or has caught up against them, or whatever, or brokered to it. A lot of us don't know about you, Arvind. So give us a little more background. So you were previous. You've been at Kiavi for some time now, but now you're in the role of CEO. Give us some more background about yourself.
Yeah, so I became CEO about 6 months ago.
Congratulations. That's a big deal.
Yeah, but I've been fortunate to be with the company for over 7 years now. Prior to CEO, I was actually the chief operating officer at the company for a number of years, and kind of oversaw a large part of like our sales operations as well as like our tech teams. My start at Kiavi like 7 years ago was actually in the capital side of the business. My background, I was actually at an investment bank at Barclays for about 10 years and change. From 2006 all the way to 2016, spending
Trading desk.
Yeah, the trading desk. Yep. So I was in the securitized products trading side. All my focus was what you would call today non-QM, kind of like non-agency, kind of mortgage lending and securitized products trading. And I happen to be an engineer by training. Studied computer engineering and actually did a couple of software internships and so forth, but ended up on Wall Street.
Oh, cool.
Yeah.
So tech background, software background, computer engineering background, goes to Wall Street and works at Barclays at one of the most esoteric mortgage desks, non-QM. I mean, it's when did you start at Barclays then?
Yeah, I started in very early 2006. Right before things got really crazy in the financial markets.
Okay.
Yeah.
So you were there on the ground floor during the meltdown, and then when non-QM started to come about, I'm guessing you were on the ground floor for that when it became, I guess, securitizable product.
Yeah. No. Exactly. It was like I would say one of the greatest learning experiences. I'm not even sure how to explain to people, the things that you learned over that period from like call it 2007 to 2010, 11. But it's given me a lot of like. I would say like intuitive power, especially when it comes to like capital and thinking through kind of market environments. And I was really fortunate to be part of the upswing as well as, starting in 2012 or so, the non-QM market started to kind of make a presence.
So you were there until your transition to what was formerly known as LendingHome, now Kiavi, right? So that you went from worked at Barclays your entire career, And then your second job was Kiavi?
Yeah, that's one of my,
That's great.
yeah,
I love that.
keeps it easy in the resume building. Yeah, but
Yeah.
yeah.
So when did you transition away from Barclays and when did you join Kiavi?
Yeah, so I joined Kiavi summer of 2016. So basically, Barclays kind of went through, I would say, what you've seen happen with Credit Suisse, right, and their whole like securitized products, capital, risk weighting, etc. And so Barclays went through that a few years ago back, and I left as part of that when they decided to unwind a lot of their mortgage operations in 2016. And actually, my wife and I just left our jobs at the same time, and my wife's from California, and we decided that we wanted to move out here. I still live in New York, and we actually moved to the Bay Area with no jobs back in 2016.
Whoa.
Yeah, look, I think back then like fintech was kind of a burgeoning asset class, and I really wanted to get back to some of the tech roots that I'd been part of after spending 10 years on Wall Street. And Kiavi was a kind of a great opportunity. And I talked to Matt, one of the co-founders, when I first started. It was great to see a company innovating on the mortgage side where I could kind of bring in some of my capital talent to help really scale the capital side of the business. And so, yeah, no, it's been an exciting journey.
So let's kind of get into the history of LendingHome, because even myself, like I live and breathe this industry. We've all known about LendingHome, now Kiavi. We have all known its presence in the market in the past 3 years. You guys are clearly, top three lender in almost every market, number one lender in a lot of markets. But there's not a lot of intel about your guys' history, right? So I know you guys were founded in like 13, right? Or 14. But give me a little bit of kind of the history of the company, because I don't even know that much about LendingHome as it first started. My understanding was that I understood that it came out during the fintech P2P lending, kind of when that really started to take off, and that was when I started at Jurassic. I remember watching that, crowdfunding becoming such a big thing. And personally, I probably got confused because there were a lot of companies that had lending in the name, like Lending Club and Lending Home. And so give me a little bit of the history there as kind of the company's, I guess, ascent to grandeur.
Yeah. No, look, it's been an evolution, I would say. Look, I think when the founders first started the company back in 2013, kind of late 2013, I started really lending in the summer of 2014. The thesis was really more around like tackling the mortgage loan origination process, and then kind of like trying to figure out how to efficiently fund it through a capital marketplace where kind of the P2P stuff comes in. And as they were building out a lot of our technology, I don't know if your listeners know, is pretty much in-house and ingrown technology that had been developed since kind of the founding of the company. And the founders, as they were developing the technology and launching it into the market, they decided to first start out with the kind of property investor space. One of the co-founders here, Matt, they'd recently been exited a startup, and I think they were being offered opportunities to invest, right? Hey, you can earn like 12%, 11% returns. And so they're really curious about, one, the sector, but also the application of what they were building in this kind of property investment market. And so they actually started lending to kind of real estate investors for the purposes of like fix and flip back in 2014, while they were also developing in parallel kind of a consumer mortgage oriented kind of your traditional owner occupied business. And so that business started out in 2015 or so. And so for a period of like 3 to 4 years, the company had like two essentially arms to it. One focused on property investors, and the other one focused on the consumer mortgage side. And I would say around like 2018 is when the company made a decision that to divest the consumer mortgage side of the business. It's obviously a very hyper competitive market there. And what we had found out was the way we had approached the property investor market, right, a very digital first kind of online experience in what was back then definitely like a hyper fragmented market, right? It's extremely offline. Really allowed us to kind of scale in this market. I'm not sure like any other company has had that opportunity to scale across kind of like a national footprint. And so we decided that, we had something here. We had customers that we were onboarding and scaling. And in addition, an important aspect of the company was the fact that we had built our in-house tech as well as like our online funnels. We were able to capture a lot of kind of structured data information and really started to nurture from like a modeling, data analytics, machine learning perspective how we thought about scaling the risk around this product as a lender. And so some of these factors just started to come together right around 2018, which is, I would say, like when the company went from being this kind of multifaceted mortgage origination shop to more focused on the property investor market. And then we
That explains so much because, like, I remember thinking about you guys early. I was doing some homework and looking at our kind of our records too, because we've been around since '07. Like, wait a minute. Like, I didn't really see. It was, and that explains it, right? I wasn't that privy to a lot of the activities because half the business was doing consumer, so that explains a lot. So I'm hearing 18. You guys doubled down in private lending, in RTL, BPL strategies. Now, Kiavi is very, very well known for its capital markets capabilities, and one of the very, very few that have successfully done multiple securitizations. Did that start in 18? When did that start for you guys? Like going to capital markets and doing bond raises?
Yeah, no, it was basically early 2019. So we started laying the foundations for it in late 2018, and then we did our first securitization in early 2019. Because I remember because we priced our deal the day before my second kid was born, so it was
Oh,
it was
nice.
great to get that done. Yeah. But it was great to introduce this asset class to like a whole set of new investors that were essentially securities buyers and not like loan buyers. And I remember even when I did that roadshow to first introduce the company and the product, right? I think I probably touched like 50, 60 different accounts. And then there was a big chasm in terms of understanding of, hey, what is this product relative to a lot of the people in the kind of the mortgage investment space come from the non-QM, kind of your traditional consumer market.
Even in 18, it was hard to understand. You're saying?
Yeah, yeah, it's a relatively new asset class, and it's still developing. I would say, we just did a deal in February, and we still get questions about like kind of basic fundamentals. And look, it's an investment, right? The way I think about it is an investment in the future of the business and kind of growing the audience there.
Yeah, I want to get back to that a little bit later. I wanted to ask the next question about the technology because at its foundation, when LendingHome was first founded, and even until today as Kiavi, the fintech component of the business is a big piece of the conversation. And this is kind of forgotten and not talked about as much in our space. And fintech as I guess, strategy has shifted a lot too, because it was initially thought of as a means of disruption, and now it's being used as an enhancement. For you guys, like, describe the technology and what it was. What's the thesis around the technology itself and how it's evolved over the past few years?
Yeah, sure. The technology itself for us, right? I kind of see it as like a few different prongs. One, it's really about when you think from a pure software perspective, it's really about how do you scale the customer experience as you yourself as an company scales, right? And what I mean by that is, look, if you were my only customer, I could give you the best attention and customer experience, right? And I'm going to kind of keep developing and growing that. But as I add more and more customers across more and more regions and markets, what technology allows me to do is really like map and scale that experience across a wider audience at bigger scale. The other aspect of technology is really more about how we use data to empower our processes and really tackle what customers want from us, right? Ultimately, when I think about the private lending space, a lot of it to me is still like, our biggest competitor is like cash, right? Like that is our biggest competitor. It's like private money, it's country club money. It's not like the big lenders in the market. It's really cash. And what we want to do through technology is really like mimic that experience, right? Like, we have a phrase here called easy as cash, right? That can we make our processes as easy as cash such that we can be almost a hyper local partner to the different investors in the market and be smart about kind of the hyper local nature of kind of real estate investing. And so that's where the
But
combination.
as foundational aspect, though, the big disconnect is in that issue. Like, that raises the number one issue I see, because I work with a lot of kind of private money lenders still, and these guys are just, you know, they see a deal, they like it, they do it, right? There's no 1003, there's nothing going on there. There's no application, there's no appraisal. Like, it's just a very, very loose process. But as a company that's reliant on capital markets and strict and underwriting strictures and operating strictures, like, how do we get closer and closer to that gap? It's a very interesting challenge to have as a company.
Yeah, and that's exactly where in the middle of, right, is really like providing our institutional investors an institutional quality underwriting, but then flipping that switch and for our customers providing a private lender experience, right? And that's the intersection of that is, I would say, where both our technology from an experience perspective, but really a lot of our data analytics and models come into play. For instance, give me a good example. I know since you mentioned it, right? Like one of the things we have developed over the last 5 years is our own after renovation valuation model, right? And that's something we have successfully launched internally, developed internally, given customers the ability to kind of close properties with our own internal valuations, which we can give them instant feedback, right? It's all about giving them the confidence at that point of purchase.
On the securitization side too, you're not going to run into any problems on the institutional side.
No, so we've taken that message, we've gone to institutional investors, and with institutional investors, it's all about like building that trust factor and giving them context to their process and why this process matters. And so we've been able to. One of the things we've been able to do with our securitizations with our institutional investors is really not just sell an asset at a particular return, it's also sell a process. Right? At Kiavi, we're using our technology and data to create the right process for our customers and then packaging that in the right institutional framework and structure so that our institutional investors are comfortable that we're doing the right things, which is our goal, right? We want to do the right things by both counterparties, but on one side we're building trust, the other side we're building experience and process.
I want to transition a little bit and ask more about you because you got a very interesting story to tell. Because my understanding, Carnegie Mellon, computer engineering background, so very common, like very prestigious school, but very a lot of my friends study computer engineering at Berkeley, computer science. They're not doing what you're doing, right? So, how did you end up on Wall Street of all places, from Carnegie Mellon,
Yeah.
studying CS or CE?
Yeah, no, it's interesting. I'd say like it was kind of an interesting period back in 2004, 2005. And I did do a couple of software internships, and a lot of my friends were kind of going to New York and going to Wall Street, and I was like, oh, do I really want to sit in a cubicle? Again, this is back then when they had cubicles for coders, and code all day, or do I want to go to like Wall Street and check out a trading desk and being this much more like a high energy environment. And like I said, a lot of my friends were going to New York, and it's a decision I just ended up making that, hey, like this is something I want to check out and I'm interested in. Like I had no idea what a mortgage was prior to the summer of 2005. Like I literally like didn't, because I grew up in apartments. My family grew up like.
Are you from the East Coast originally, or like where did you grow up?
No, I kind of grew up all over the place. I was born in India. Then, my dad moved out to seek better opportunities. So we kind of grew up in Oman and then Dubai for like a large part of my life.
Okay.
Yeah.
Oh, all over the world.
Yeah,
Fantastic.
yeah. My parents kept traveling, and I came to school here in Pittsburgh. That was my first introduction to the United States.
Right. Oh, what's one hell of an introduction. Great campus.
Yeah, but so yeah, that's kind of how I ended up on Wall Street. Didn't have a particular I would say axe for like mortgage securities trading.
Silicon Valley wasn't knocking on your door because I went to school in the Bay, so every kid that was anything remotely close to computer science was immediately whisked away to Palo Alto. Like it wasn't a question back then, So, but I guess in New York, Wall Street's there, so and math is math. So
Right, no, yeah, they were hiring pretty heavily in the quantitative side, and it was just alluring and something different. I'd been coding for like 5 years, and just wanted to check out a different lifestyle and world, and yeah, it was just a great fit and a big learning. I think what made it more interesting was like the learning process and the education that I got by being in that seat for like that period in time, right, in the world.
And you transitioned to LendingHome in 16 and on the capital markets side, and give us a little more of the journey as from I'm guessing VP of capital markets or investment, and then your journey to the position of CEO, because that's quite the story as well. We very rarely see, like we talked about this before we started the podcast, like very rarely do I see national lending operations have someone from capital markets be their CEO, number one. And at least a retail shop, right? And there are a few aggregators and table funders that have that, but a retail shop, very, very rare. And then second, on top of all that is it's an internal hire. Like very rarely do we ever see that too. Like you were I didn't know that about you. Like you were inside the business since 16. So Tell us more about, kind of the rise of of Arvind inside the company.
Yeah, sure. No, happy to. Yeah, so I joined, really to do, it was called like Director of Investor Development, which basically, as I mentioned, right, they hired me to go sell their loans essentially. And, for me, having worked on Wall Street for 10 years, I had established a lot of like contacts on kind of the investment side of the world, and was an opportunity to like kind of introduce and learn about this new asset class and learn about fintech in general. Was my goal was to like understand what all the fintech hype was really all about, and so I started there. But what I really loved when I actually like dug in was, and I think this is true of the private lending space in general, it has this kind of opaqueness to it, as well as from, I would say, like an institutional perspective, there is no like framework, right? It's not like you have like specific guidelines or conformity. It's essentially a greenfield in innovation on how to lend to this audience. And that was what I think was like super interesting to me. Sitting in my capital seat, I was talking externally to investors. What I saw was like a complete, I'd say, lack of understanding of the product in some sense. Not to say like people didn't understand the product, but a lot of people came from a non-QM background, right? And they think about this very differently. Like people aren't used to 7-month mortgages, right? Like the concept of 7-month mortgage doesn't really like exist. And what I spent a lot of my time on actually was internally at the company, understanding, hey, like why do we do things the way we do things, right? Like why is a credit derived this way? Have you thought about this? And really start to build some of those connecting blocks between the customer and the investor. And I would say like that interest and that desire got me a lot more involved in the operating company, essentially. So coming from the capital background, I kind of knew, okay, this is how investors think, this is how investors in general think, and kind of understand the product. Like how does the sausage really get made, right? And how do customers think the sausage gets made, and how do they see it in their day-to-day lives? So I've actually spent a lot of time both internally with the company as well as talking to a number of customers, understanding, hey, what are your pain points? How does business operate from your perspective? And so I grew from, then eventually running capital markets to running capital markets and like our credit. I kind of think credit and capital go together. If you have good credit, your capital life is very easy. But credit again is the lifeblood, right? So capital is the fuel, and credit is how you channel that fuel to your customer. And so from a credit perspective, really that was an opportunity for me to even get one level deeper in understanding process and process optimizations and what data and other information advantages we had. So we could actually design, going back to some of my original comments, right? Like what is the right process from a customer's perspective, right? How do we drive the best customers to LendingHome back then, but then Kiavi? Because once you get the best customers, right, and you keep them, you start to build a really, really strong portfolio in this space, and it becomes less and less opaque from my seat. And so when Matt transitioned out of the company, and Michael, the former CEO, moved up, I moved into the COO role in kind of late 2020 and started to oversee sales and operations and biz ops alongside my capital and credit functionalities.
Interesting way to look at it, because I very rarely do I meet a COO or someone who's been in the COO seat think of capital and its importance as it pertains to the operations of a lending business, because obviously massively important, but you're viewing it as a way of, it's a process and procedure issue of the way capital integrates into that, and also the lending process. It's a very interesting perspective, because you're bridging so many different gaps, because most people in the shoes of a COO are really concentrated on the borrower experience and how the loan closes and the internal operations and the HR. They're never really thinking about the intersection between capital and credit, like you said, right? So that's really, really, I guess, to me, very novel to see that internally inside of a company. Now that you're CEO, right, of the company, and I mean, Kiavi is, number one in many, many markets, and you guys are top market shareholder. I think you guys hold, I know, at least 7 to 8% of the market. Tell me more about kind of what you're excited about now, and what are some initiatives that you're pushing as CEO of the company.
No, for sure. Yeah. It's probably three things I would highlight. I think one, while we're a leader in the fix and flip side, we still have a lot of opportunity to continue to grow our kind of lending product suite. We've launched our rental single asset product, we've launched our rental portfolio product, and we think there's more opportunities for us to continue to expand within even just the kind of property investor short-term lending universe, as well as kind of for kind of products geared towards kind of landlords. And we've also historically been, I would say, much more of a direct lender, and we see opportunities for us to continue to scale in certain markets. I think the whole like last mile problem exists even in this market. Like once you get to like the local markets, like how do you get that next customer? And so we have some ideas around there in terms of like acquisition channels and innovating a little bit around continuing to grow our addressable borrower base. And second, it's really like, again, going back to like the core technology and data, right? We still see a lot of opportunity to continue to innovate in this space. We're scratching the surface of how we think about using like our machine learning tools in production, and continue to work with our investors to like give them an idea of, hey, like the right process gets you the right customer, right? And really continue to drive that positive selection in our portfolio. And lastly, look, I think the success is not just like me, all right? It's a team effort, and I want to continue to work with our leadership team, our senior leaders of the company, and really continue to bring them along. I think one of the beauties of Kiavi that I've seen after being at Barclays or a financial services company is you have a big diversity of kind of people and diversity of talent at this company. There aren't many lenders that have like engineers and like designers and like product managers working alongside like sales executives, right? And like underwriters. And so kind of bringing folks together to see across the commonalities to drive for our customers. Like that's I would say the third prong of my what excites me.
That actually raises an interesting question. Like, I don't know the answer. I wasn't sure about this. Is like, I didn't lending. So Kiavi has always been a retail lender. They've always been a direct lender. But did it have a wholesale arm or a correspondence type arm before, or does it currently have one? Or I don't know much about that part of the business.
Yeah, sure. Yeah, no, historically, when we started out, it was a little bit more like 50-50 between a bit of broker channel. It was all like non-delegated, broker brings us the customer and we underwrite it. And, we have grown mostly through the direct side of the business, directly acquiring customers. This is again where we use a lot of our data analytics to target customers very efficiently and convert them. But I think more recently, as you've seen kind of more stress in the market over the last year, we've started to see more broker participation in our funnels. And so like the broker volume has gone up. Historically, it's been like 5 to 10%. I think it'll get closer to like 15 to 20% this year. And so like, yeah, so we have an 80% direct, call it 20% kind of broker driven. But all the underwriting is again done in-house by Kiavi.
Right. Like LendingHome and now Kiavi has never been in the TPO,
Nope.
kind of business.
Yeah.
Yeah. Okay.
Yeah.
That clears a lot of the arrow, because a lot of folks kind of assume that when you're a national shop, you have both, right? So
I think that's one of the advantages for us, and why, like, we've been able to scale and grow and keep our customers and, keep them happy, and also learn, right? And develop a really solid footing with our capital partners.
well, let me ask you this. So product wise, for a long time, especially since probably like I would say before 2020, even, Kiavi has always has been known for the longest time as being a DSCR player, right? One of the largest DSCR lenders in the country. And, while we knew you guys to fix and flip, like currently for you guys, what is the ratio of your guys' origination volume, and where are you concentrating kind of focus? Is it more on DSCR, rehab, both? I'd like to know more about that.
I would say we're trying to grow both those products. I think fix and flips continues to remain like our primary core product. It's about 80 to 80. Yeah, it's about 80 to 85% of our volume on a monthly basis. And then the DSCR products, the rest, call it like 20% of our volume. But we are making efforts to kind of grow on the DSCR side even more. It's a little bit of a challenging market today with kind of where prices are, cap rates are. But one of the investments we made more recently and we've launched and starting to scale is more up on the portfolio side.
You guys used to do a lot of those bigger portfolio loans back in like 1920, and like we're trying to bring that back now.
Yeah, so we've been basically incubating the product with some of our top customers, just kind of learning, what works. And now we have a full dedicated team addressing the portfolio product as well as, it's on our website. So you can go ahead and apply for a portfolio product. And, we're going to continue to kind of expand. Right now we have a portfolio DCR underwrite product, and we're going to kind of continue to move into the NOI underwrite phase as well. So we can address kind of larger portfolios.
What kind of challenge does that present to the operation? Because you're basically, I mean, to the audience who are uninitiated, a portfolio loan is basically one giant loan, cross collateralized, a tape of properties. And so, I mean, for you guys, it must be a much more complex process and lift. How are you guys? What are you guys trying to do on that side to make it easier?
Yeah, look, our strategy there has really been to run that as its own vertical. I think that was kind of our simplest go to market, and not entangle it inside our entire kind of like technology offering.
Separate channels, separate resources,
Yeah,
separate people.
exactly,
Okay.
exactly.
Yeah.
And for us, the advantage really is, from a customer acquisition perspective, we can offer the best competitive, I would say, fix and flip product in the market. And a lot of times, kind of the bridge product, right, is the funnel to the portfolio product. And that's our play there. We already have a lot of the top customers like borrowing from us, and we kind of see this as a continuation of that journey, and continue to help them kind of grow passive income.
Great. And so I guess from a growth and scale standpoint, one of the questions that I had when doing my research about Kiavi was, has Kiavi been, I guess I call it, quote, privately held or independent this entire time, or is there an institutional capital partner that's kind of, in the past 3 or 4 years now, a lot of the national shops have been bought and sold by some of the institutional, investment, Pretium, New Res. A lot of these players are in the space now owning lenders. Did Kiavi ever have that happen during its life cycle since 18? So, or I guess 13?
No, so we've actually been, fully private. We're actually a fully VC funded company, and so we have
The technology aspect. Yep.
right.
Yep.
So yeah, so we haven't attached ourselves. I think we're probably the last like large independent lender out in the markets not attached themselves to like yeah. And a lot of that is due to like our execution on the capital side, or how we have set up like our funding models, running the business profitably.
That's great. And VC hasn't come, you guys were smart about your VC, it sounds like, because that can be a double-edged sword for a lot of these fintech companies. That we've seen a lot of that happen over the past few years. I mean, recently too, VC funded organizations, both in this side in our real estate, have suffered because they overdid it on the VC, and were not able to meet the obligations they were set out to do. So kudos to you guys. That's great. I'd talk to you more about kind of where we're headed right now, right? Because you've been in the space for a long time, both on capital and operations, at a household name private lending organization. Currently, we're in early July of 2023. This episode is going to air a little bit later than this. We've had some tough times
Yeah,
past year, haven't we?
yeah. No, it's yeah, look, it's been challenging. And look, I wouldn't say like Kiavi is not being like immune to everything. I think we've just done a better job of building resilience in our models, right? And so we can kind of continue to service our customers. The really important thing for me and for the company in general is making sure that we are a reliable partner, right? We kind of view ourselves as a partner to our customers. Like all the data we have, all the technology, it's all for want if we can't give our customers capital when they need it. Right. And so like I think a lot of things we do is like, hey, let's innovate on these things, make the process simple, but ensure that we're always there to deliver for our customers, right? And be that reliable partner for them.
But with capital markets just turning upside down and the bond market pretty much becoming very challenging to price anything, have you guys had to make any hard pivots at all from a capital sourcing standpoint, or have your investors been able to stick by you and continue to do more securitization?
Yeah, like so far, touch wood, like our investors have stuck by us. We continue to diversify our channels, and as we grow the business, continue to establish new capital partners. The securitization program is always going to be a core part of our business. We want to be in front of our in front of those institutional investors, right, and kind of show them what we're doing through the cycle, through this market. Yeah, look, it's fine. Like you're not going to do every deal at the best spread or the best price. But again, this is the long game, right? You're building kind of institutional relationships, and that are channeling capital to you as kind of like the leading lender in the space, which we can then channel back to our customers.
Has there been any, I guess, challenges or speed bumps in your way caused by a lot of the disruption in the space? Not necessarily from a I guess, interest rate standpoint or inflation related, but there's just been a lot of disruption in the space, right? Bank troubles, regional bank troubles. There's been a lot of volatility when it comes to different operators in the space. One that was a primary competitor of yours is no longer around, and other aggregators going away, and all of these strange events happening in our sector that are impact our sector. How have you guys been affected by that, and how have you weathered it?
Yeah, no, good question. I guess there's a lot to dig in there because lots happened over the last 12 months.
A lot's happened.
Yeah.
The banks. Let's start with the banks. I mean, when the banks with the regional banks, we had SVB happen. We had a few other regional banks get in trouble. How did that impact you guys at all?
I would say luckily, like we have set ourselves up with like real, like, top tier investment banks in the business. And so like our partnerships there are extremely strong. Those partners have been with us, like one for the last, call it like 5, 6 years, and the other for the last, like, I want to say almost like 8 years, like almost since the founding of the company. And so they have seen the evolution of the company, through like COVID, through the pandemic, through the cycle over the last 12 months. And they're extremely supportive of like how we're running the business, our discipline. And so that's been actually really, really nice to have, right? Like one less thing to kind of worry about from my perspective. And also the beauty is, right, for us, like having set up these securitizations, having set up like a good depth of institutional capital, we are able to show them the liquidity that we have in the markets, right? Like things go on, things go off, and that's what warehouse lines like, right? I like to see like things rotate out, and that's kind of what we're after too, right? It's about the velocity of the business for us. And so from a banking crisis perspective, we've been kind of so far like relatively immune. We kind of could, on the flip side, almost see it as a little bit of an opportunity as kind of more production leaks out into the private lending market relative to kind of bank balance sheets. I think like macroeconomically, the other things, right? I probably kind of bucket it as kind of like the three events from a customer perspective, at least, right? That we're trying to manage through. One is obviously, as you mentioned, pricing. Capital markets remain extremely volatile, which means like things are going to remain expensive for a little bit longer. And then you've seen housing velocity slow down quite a bit, and so that makes finding new opportunities obviously a little bit more difficult because of the lock-in effect. And then the flip side, when you go to sell properties, while there's demand, affordability kind of plays in, right? You're kind of seeing disparate impacts of that across the country. So it's kind of this little like triple whammy. But so far what we're seeing is like our customers are pretty well positioned. People are definitely scaling down the level of business they're doing, but they're still active. They're smart about the decisions they make, and in some sense, they're better positioned than the consumer, right? Because they have purchasing power. They have like the logistical and labor capabilities to fix up a property. There was a journal article the other day talking about like people avoiding fixer-uppers because it's expensive. And so there are mitigating factors to these things, but yeah, the environment definitely is still like very much like volatile.
And has there been any challenges faced in market specific, right? So we had it's all public knowledge now, right? It's July 6th today. Recently, we had the announcement that, Pierce Street's filing BK. Recently, Rock 360 purchased what was left of Civic from the bank, from PWB. A lot of crazy things happening in our sector, right? And so, have you guys felt any pain, during these volatile times? Have those events affected you guys at all?
Yeah, for sure. I think, like, for example, we had to downsize the company a little bit in the second half of last year. We're probably early, but, we kind of saw the signs, and we've adjusted both from a credit perspective as well as kind of like a cost structure perspective to ensure that we can have good runway and visibility and, give our teams the confidence that, there's going to be less flux in the system. Even though the world outside is volatile, kind of the world inside is, hey, let's keep our heads down, focused, and execute on a roadmap, and things will be fine. I think from less so from an M&A perspective, a lot of the stuff that we have developed, we've tried to do it very organically. But if there are like opportunities where there are bolt-on for products that we don't have today, I think what we can offer is like our technology and scalability relative to kind of inserting a new product into our product mix. And so those are things we'll kind of keep an eye out for.
So I want to ask you some questions about kind of where we're headed, because being in your position at one of the nation's largest private lending shops, you have to have a bunch of data and a bunch of analysts kind of studying where we're going. Because you just mentioned it, you just said it, right? We're to put it simply, it's painful right now, right? It is challenging, but it's not. We're not in the doom phase, right? We're not in this doom cycle, but it is painful. Has been troublesome. June was better than May. May was better than April, but still, not so hot. Where do you think we're headed? Because everyone has had their perspectives on this. I've heard projections of early summer. Well, we're past early summer, my
Yeah.
friend. So, know, we're almost headed into fall. So, what do you think? Like, where are we headed, and how much longer for the pain to go on?
Oh man, yeah. I really wish I had a crystal ball on this one. It's
No one does, right? But I would like to hear your thoughts on it at least.
Yeah, so my thoughts are, look, I think if you read the Fed, right, and they seem pretty much hyper focused on ensuring that inflation, is actually coming down quite a bit before they even think about cutting rates. And so I think the trajectory there is going to continue to disappoint the markets, which probably means kind of like higher rates for longer. Now, like I can't predict like how quickly they're going to react when things break. I was reading an article the other day that basically said, the Fed fund futures were always wrong, right? They're underestimate and they overestimate and they overcorrect, undercorrect. And so I think from my perspective, look, I was in the camp that maybe hey, things will be better. This is again going back to last summer. By the spring of 2003, clearly I was wrong about that. But I do think over the next, call it 6 to 9 months, you should start to see more clarity. And look, you actually don't need, I would say, what the markets want ultimately is like more directional clarity. Hey, where are things going with confidence, right? And I think, unfortunately, what we haven't seen from the policy side is that confidence being projected, right? I think being data dependent means every week looking at the data, even this morning, right? The jobs number, the ADP number came out, and there's a big sell off in the market, and rates moved higher because everybody's pricing every data point relative to how the Fed's going to react to it, right? And so it creates this uncertainty on a daily, weekly, monthly basis. And so until you get out of that cycle and you get to a place where like with high confidence, people can like project out what their cost of capital is going to be, what their return hurdles are going to look like. It's gonna be a struggle to get kind of margins compressed and spreads compressed and kind of pricing back into the game.
And that perspective is exponentially important when it comes to Wall Street, right? When it comes to institutional investors, if they can't project, they can't price, and they're just going to exclude themselves. At least that's what I've been told. They're not even going to speculate at all. There's no point in that.
No, and so that's why I think spreads remain wide because the margin of safety from their perspective effectively needs to be higher and higher, and so that means say cost of capital to lenders goes up, and it has makes life more expensive for everyone.
Right. I mean, there's been talk about us being closer to, I guess, when I first joined private lending at Jurassic, pricing in California was close to 12%. And there's been talk, like, different circles, and people have been projecting we may end up back there. And, East Coast markets may start seeing 14, 15%. We're hearing it in tertiary markets like Birmingham, Alabama, and stuff like that, but we're still not hearing it in New York and Florida, right? So, it's an interesting perspective. I wish it were the case, but at the same time, I don't even think that's going to give Wall Street any certainty anytime soon. But that's what we want. So with that uncertainty, right, have you guys been able to continue on the securitization front? Have you diversify capital strategies altogether, or how is that playing out for you guys?
Yeah, no, I think it's playing out well. Like I said, I think securitizations will remain a core part of our business, and we'll continue to be in the market there, doing deals, as we grow. I think for us, the way we've structured them as revolving securitizations, we're able to kind of efficiently reinvest, and so our customers are executing actually at a pretty good, decent pace, and so we've seen a lot of turnover in our deals, and so we can fund our new production without having to go to market as frequently as we expected. We also supplemented with like whole loan sales and starting to establish kind of new partner relationships in that space. But again, like we will be back in the market, and our goal is to continue to execute these deals. That's an important channel for us, and those investors are important investors for us to continue to kind of build trust and relationships with.
Going into 24 and 25, what are some of the key initiatives that Kiavi's working on? Because you guys have continued to maintain strength throughout the past year, and you're growing, it looks like. So what are the initiatives that you're tackling? I heard portfolio loans being one of them earlier.
Yeah, so like, maybe I'll give you like three hints into it, right? So one is kind of like on the product suite side. Today we do kind of like a lot of like fix and flip. Our loans, like, people buying a $250,000 property. Our typical loan, sorry, is like a $250,000 purchase with like a $50,000 renovation budget attached to it, right? And we see opportunities to continue to kind of grow and scale that into like a little bit more larger rehabs. We want to also start to expand more into kind of the infill, kind of, I would say, urban infill construction space. We're not going to go start doing like horizontal, 24 units by any means. But we see an opportunity again within our existing customer base to have some of these, what I would call like density transactions, really. People taking like single family, making it 2 units, or adding an extra unit here or an ADU, and so we opportunities there that are both promoted by a lot of local markets, as well as customers see opportunity there from a value add perspective, and so you'll see us expand in that direction. And then, as you mentioned, right, the portfolio product is going to be a pretty important product for us. We want to continue to invest on the DSCR side, the portfolio side. And really there, like we want to continue to start to like build our data advantage and think through like, okay, how do we like more innovatively address this audience, right? And think through that. And then and the other thing I mentioned earlier was around like our acquisition channels, right? Again, today we're like 80% direct and 20% are done through brokers. And we feel there's like some opportunity for us without going into like a wholesale TPO program to continue to drive that diversification and really try to get more efficiently in that last mile kind of next property investor customer in our doors. And so those will be kind of initiatives to scale the lending business. And then I think the third thing that we're exploring and thinking through, and obviously kind of slow playing it in this environment, is really pushing some of our data advantage out into the market more cleanly. Today, we are kind of reactive, right? A customer comes to us, provides us a deal. We like, hey, here's what you think, here's what we think. We do the matching and we make a deal happen. But it's an opportunity for us to continue to kind of push some of our underwriting models more from an acquisition or disposition perspective for our customers, so that they can actually get positive selection even one step higher in the funnel, right? And if they're buying a already, say, pre-vetted property.
Oh, I see. So transition that into a tool for your borrowers on the acquisition side and have them utilize. That's a good idea. I mean, you guys are already sharing notes anyway, so that makes sense.
Yeah, and so we'll continue to kind of branch, I would say, on the property dimension a little bit more as we expand our lending footprint and kind of customer acquisition channels. And so kind of putting that package together, I would say, is kind of like our goal over the next 24 months.
We're going to see a Kiavi prop tech startup pretty soon. Sounds like it. All right, cool. All right, so we're going to get into the rapid fire questions. These are more fun questions to get to know about kind of how you are as a professional. So one of the questions I always like to ask is kind of more of an advice question. So if you had to give a piece of advice that you received and you still use in your career today, what would that piece of advice be?
Control the things that you can control, and build the best kind of path forward. And if you worry too much about the things you don't control, it's not going to end up as well.
Concentrate on what you can control, for sure. If you could have 30 seconds with everyone in the private lending industry listening, the entire industry, I'm talking mom and pop, to your competitors,
yeah,
to your big borrowers all across the country, what would you tell them?
I would tell them that today the world might be uncertain, but uncertainty breeds opportunity. Be smart, be cautious, but a trusted partner like Kiavi is here to help you, and feel free to check in. That's what we're here for, through partnership, and to give you that second opinion, and make sure that you can execute and you have the confidence to execute.
Abundance mindset, I like it. All right, this is a little more fun one. Is there a unique item that you keep on your desk or like your workspace that's very, very much, for you?
Unique item. I have like this like pocket knife multi-tool thing that I fidget with when I am in meetings. So I have like a fidget gadgets, and then occasionally whatever toy my kids leave on the table as they go by.
That happened to me one time during COVID. My kid left it's like a puzzle toy that little kids play with. It's like, the ones you pop.
Yeah.
I was just playing with it for almost a year.
There you go. Yeah, it happens.
All right, last question can you share with us any go-to productivity or time management tip that you use to keep you on top of your game?
Yeah, the one that I've used is the Eisenhower matrix. I'm not sure if you're familiar with it, but it's kind of like kind of 2x2 matrix. Kind of has like you kind of break your task list by important and urgent, important but not urgent, and then you have like not important but urgent, and then like not important and not urgent.
Yeah, quadrant 1, quadrant 2, quadrant 3, quadrant 4.
Yeah. And
Yeah.
it's a way to like prioritize, right? And also like I think for me in my role, right, I really like delegate and think through, okay, what are the tasks that I should be focused on, and what are tasks or opportunities for leaders in my company, and what are tasks I should not even like be focused my time on. So it's a good development tool as a manager as well, because you can then delegate appropriately.
So back to the whole thing, focus on what you can control.
Yeah.
I like that.
Yeah.
Very cool. Very cool. So, this is your first podcast, and I think also like kind of one of the first speaking gigs we've done. You've done as CEO of Kiavi. What's next on the agenda for you? What are you going to be working on from a public standpoint? Are you doing more of these speaking engagements?
Yeah, definitely. Yeah, I really appreciate you giving me the opportunity on your platform, Kevin. But yeah, look, I think continue to get the name out there, get the Kiavi brand out there. We have a really good brand in the market, and want to continue to like stress that look, we're here for our customers, we're here for our investors, and really want to kind of continue to bring capital and innovation into the private lending space. That we kind of believe here, right? Like real estate is a great wealth building opportunity. And we want to empower more and more people to utilize real estate with confidence as a wealth building tool.
It's good to me. Well, it's been a great opening episode. Thank you for doing this today for our very first episode of season 4 of Lender Lounge. I want to thank you and the whole Kiavi team for joining us on this episode. And definitely everyone, our audience, keep a lookout for Arvind. He's going to be out there preaching the Kiavi gospel. So hopefully you guys will see him out there. And please tune in for the next episode of Lender Lounge with yours truly, Kevin Kim. This is Kevin Kim signing off. You've been listening to Lender Lounge with Kevin Kim, brought to you by Gerasi LLP, the nation's largest private lending law firm. Gerasi is the leading legal resource for specialty lenders, asset-based lenders, private lenders, and non-bank institutions. Learn more about the firm at gerasilawfirm.com. That's GERACI lawfirm.com. Check out our episode summary to subscribe to our Lender Lounge newsletter and our law firm newsletter, where you can get notified about new episodes and recent content directly from our expert attorneys. In addition, we'd love if you follow Lender Lounge with Kevin Kim on YouTube, your favorite podcast platform, and on LinkedIn, where you can also check out updates from Gerasi LLP. Thanks for listening, and we'll see you next time on Lender Lounge with Kevin Kim. This is Kevin Kim, signing off.